You have questions, we have answers. This is Jane Muller.
And this is Ken Muller. Welcome to our show, all about real estate with Ken and Jane. Today, Jane, we have a very exciting topic. We're going to talk about real estate accounting issues. We have so many clients and listeners that always are asking us questions about, what are the accounting issues? What can I deduct? What applies for when I sell my home? Am I going to get taxed on it? So to discuss it all, there's no one better than we have a CPA, Certified Public Accountant, Ajkumar, as our guest today. AJ, I want to thank you so much for joining us and welcome to our show.
Thank you, Ken. Thank you, Jan.
Yeah.
I appreciate that.
That's really awesome for you taking the time out of your busy day to be with us.
It's my pleasure.
So let's start with the basic question that is the most common, and that's the IRS rule on the sale of somebody's principal residence in New Jersey. The tax, what are the tax-free implications? So let's talk about, first of all, what qualifies as a principal residence, and if you do qualify as a principal residence, what are the tax-free implications for a single versus a married?
Yeah, absolutely, Ken. This is a very, very common question that we get all the time. So in order for someone to qualify as a primary home, you must be living in that home for at least 2 years out of the last 5 years. A lot of times what happens, you live in the home and then you move to the new home and you put the older home as a rental place, as an investment property. Mm-hmm. So if you intend to sell it, you have 3 more years to sell it to still qualify 2 years where you are living as a primary residence out of the last 5 years, most recent 5 years, in order for you to qualify that place as a primary residence. IRS allows up to $500,000 for a married filing joint situation. Up to $500,000 of gain is non-taxable. We want to clarify for our audience, $500,000 is the gain, not the selling price. Let's say if you bought the home for $300,000 and you are selling it for $800,000, even though you are getting $800,000, your gain is only $500,000. And then you can, out of the gain, you can also subtract the closing cost, the fixes, the repairs that you may have done, the improvements that you may have done in the home, in the primary home. They also come out of the capital gain. Up to $500,000 of gain is non-taxable for a married filing joint tax return. If you are single or married filing separate type of situation, then you can exclude up to $250,000 of gain.
Right. So that's why it's very important. That was one of my questions down the road. So if you're a homeowner out there, you should always keep records of any home improvements you do, even things, because that'll further... Because when you go to sell your house, that adds to your basis, and by adding to your basis, you're reducing your gain. And even though currently right now the IRS it's a very generous that the capital gains are, like you said, $500,000 married and $250,000 single. But if you did a home improvement for $50,000, does that include things that not necessarily expansions, but if you improve the kitchen, if you upgrade the kitchen and it costs you $50,000 to put in a new kitchen, that adds to your cost basis too.
It does,
correct?
Absolutely, and very well said, Ken. A lot of people don't really put enough importance in maintaining the receipts, in maintaining those records, only because those records are not tax deductible during the year when the improvement was done. So if you have an investment property, everybody knows they need to maintain the record. Right. When it comes to the primary home, a lot of people ignore the fact that when they sell the home, they can use all those receipts, all those records to minimize their capital gain. Let's say if you bought the home for $300,000 in our example, mm-hmm. and you are selling it for $1 million. Mm-hmm. Now your gain is $700,000. IRS will only exclude $500,000. You have to pay tax on the $200,000 unless you can justify there are capital improvements, expansion, improvement in the kitchen, changing the roof, anything.
Even routine like maintenance, like painting costs and things like
absolutely,
that
anything.
Anything you do.
Anything that you did.
Or if you have to replace
the only caveat is you cannot be taking the expense deduction. Let's say if you have a 2-family home and the improvement happened in one family which is rented, and you have already claimed that on your Schedule E as a rental deduction, then you cannot double dip. But anything that you have not claimed earlier mm-hmm. is an expense.
Mm-hmm. Mm-hmm. Yeah.
That's a great information. And what that means to the audience out there is, I have a real case. I have a client they bought a house in East Brunswick. When they bought a brand new home, when the home was built in 90s, they only paid $250,000. At that time, $250,000 is $250,000. It's a lot of money.
Of course,
so
of
they
course.
bought it. And then, unfortunately, when they call me, they want to sell the house. It's just 2011. Just, flashback, 2011 was really lower point and it's still going lower. At that point, right, we have a lot of foreclosure hit the market. The market is really lost the complete in confidence. A lot of buyer, you give them the house free, they may think about it because they think tomorrow they can buy cheaper. Even though today the price already 20%, 10%, 20% reduction from 2007, 8, and 9, they're still not enough because buyers afraid the market go further down. At that point, when the client contact me, said, Jane, I wanted to sell the house. I said, although you purchase house $250,000, you may get $450,000 now because market is low. You still gained, right? I would highly recommend because when the market is a cycle, when they go low, they will go down. I said when you hit the broad bottom, there's the only way going back up, right? So I said that's rent it out and see what happens, right? But buy us at least another 2-3 years.
Right.
So, but I also mentioned to them, I'm not an accountant. Please don't take my advice as a professional. Speak to your accountant. They said, really? I thought you have to buy a bigger house to change. I said, no, current the rule for the home resident is not you sell one, you can buy a bigger one. It's different. It's like a $250,000 for a single, $250,000 for single, and $500 for a couple, married or fell together, right? But talk to your accountant, please. Here's
Absolutely.
a good one.
Yeah.
So anyway, so after consult accountant, my client said, oh my God, I can't believe it. So I rented a house out for 2011. 2012, which is go even lower, so the seller was really nervous. My God, I should have sold it. And 2013, the market came back.
Yep.
So we sold like at the end of 2013, early 2014. So we sold 500 and a quarter, 5 and a quarter, and 5.5. So in that transaction, potentially we help owner gain another 80,000. Why? Because the market is a cycle. When just like a stock, right? When you sold the lowest point versus upswing, so that's the saving, right? Because
Absolutely.
as a professional, we always use our knowledge to help our client. It's not like only win and lose between the seller and buyer. Sometimes you can take advantage of interest rate if you're a buyer. You can take the advantage or the market if you're a seller. But consult your accountant, please. Some agent will like myself know because we do continuing education and we do attend seminars to keep ourselves open. But some may not. So always ask the professional, ask your accountant before you make any decision.
Absolutely,
Right.
Jane.
Yeah.
Right. And also, AJ, there's a sidebar to this issue. We've had clients that oftentimes have a home in California, but they move to New Jersey due to job situations. So oftentimes they have two homes, and then when it comes time for them to relocate back to California, they say, they ask us sometimes, can they sell the New Jersey home and take advantage of the principal residence tax exemption?
That's a great question. So the way we look at it, we will decide where the residency is. If you are working in New Jersey, and let's say hypothetically you have driver's license from New Jersey, you can justify that on your tax return for last 2 years, New Jersey was shown as the primary residence. See, the tax return can only have one address. When you file the tax return, it will ask you what's the primary residence. And on that tax return, you can only claim property tax for one home. If that happens to be your New Jersey home, if the tax return shows New Jersey as the primary residence, if you have the New Jersey driver's license, it shows you have residence in New Jersey. In that case, you can show that for these 2 years, this is my primary home. And then you can get the deduction for it.
Okay, great. Thanks for
Okay,
clarifying
that's
that.
a very good information.
Absolutely.
Good point.
Yeah.
And again, we want to remind the listeners that whatever we're discussing today is meant as general information and even what AJ is giving. So if you need specific advice, please contact him. And AJ will allow you to give your phone number now. We'll say it a few
Absolutely.
times during the show. But if anybody wants specific accounting advice to their particular situation, please reach out. We have a very good accountant, AJ Kumar. He's a CPA. And AJ, what's your phone number? If any...
908 908-380-6876.
Okay.
Again, 908-380-6876.
Okay, perfect. Thank you. Right. So the next logical question would be, if a homeowner doesn't qualify for the residency, if they're subject to taxes when they sell their house, typically, again, this is all general information. Every situation is different, but in general, the capital gain that's taxable by the feds and the state, what percentage roughly? Let's say they have $200,000 in profit, and that's not subject to any of the exemptions we've covered. What would be the tax rate?
Roughly, it could be either 15% or 20%. In this example, if the capital gain is $200,000, depending on what other income they have, what's their W-2 income, that can push them to 20%. But otherwise, assuming their income is $100,000, as long as the income is under $400,000, they will be on 15% tax bracket. We have to look at what other incomes are in this situation, if it's married filing joint or a single filer. So there could be some variations, but the tax rate could be either 15% or 20% for a capital gain situation. In this situation, when they are selling the home and they did not live in that home for at least 2 years in last 5 years, in that case, the capital gain taxes could be as much as high as 20%.
Yeah. Or if their profit exceeds the allowable limits, like if they're single and they make more than $250,000 in gain, or if they're married couple and they make more than $500,000 in gain, then they would be subject to, like what you just said, the 15 to 20% tax on that additional capital gain.
Absolutely, so very well said.
I have a question.
Please.
The tax gain is on the total or just exceeding? Say, if a married couple, Ken and I, right? If we qualified the first the 500,000 and we made 600, so is the capital gain on the whole 600 or is it on only the 100?
That's a great question. Only the income tax bracket is decided by the total income. So we'll decide if we want to charge you 15% or 20% based on your total income.
Okay.
But the capital gain tax, whichever we decide, either 15% or 20%, is only going to be on the capital gain.
Okay.
In this example, let's say 200,000 is what we will be charging you, either 15% or 20%, but we'll decide what rate to charge based on your total income.
Okay, total income.
Based on the total income. Very interesting.
And only charge on that access.
Only on the access.
Yes.
So as Ken clarified,
Yes.
if the capital gain is 600,000 and the exclusion in this example is, let's say, $500,000.
Right.
So we'll charge only on $100,000, but how much to charge? 15%, 20%, or 0%?
Right, and that's all based on your other income. That's why
Based on the total income.
The total income, and that's why this show. That's why we're just giving general guidelines.
Absolutely.
And percentages will vary, and situations will vary based on each individual's particular needs.
Absolutely.
Now let's talk also about the New Jersey tax implications on that. How does, if at all, New Jersey tax the sale of homes?
So New Jersey does not consider the capital gain. New Jersey will still charge the regular income tax that can vary from 5% to 9%. Depending on what your income tax bracket is, New Jersey will charge their own income tax, and that can vary depending on the income tax bracket up to 9%.
Right. So in other words, if you sell your house in New Jersey and let's say you qualify for the IRS exclusion and let's say you make $400,000 profit, a married couple, that $400,000 of profit does New Jersey look at that, and are there any tax implications to the state of New Jersey?
No tax
in general, right?
In
general, no. So that's a wonderful. I find this to be like one of the few great provisions, benefits of the tax that the code that Congress hasn't eliminated as of now.
As of now. And if you think about it, you can keep using this thing every few years.
Right. You're right. You can use it, but you can't use it more than once every 2 years, right?
Right. Every few years, meaning every 3-4 years, every 5 years, you can do that.
Yeah, that's quite interesting. But then we'll talk about it after the break. But then could the IRS view it if you do it every 2 years? Could they view it that you're doing it as a professional basis? And I heard some accountants one time mention that. Why don't we take a short break and we'll talk about that more right after these messages. Thanks. Okay, welcome back. We're joined today with Ajkumar. He's a certified public accountant. AJ, thank you so much for enlightening us and the listeners and all the interesting tax benefits of real estate sales provide.
Absolutely.
Right. So before the break, we were talking about the situation when basically New Jersey, and the that fact that the state of New Jersey doesn't charge any taxes on the gains, on capital gains for the sale of residential homes. So that's a great benefit. And then we started saying that people, in terms of the federal exemption, you theoretically, homeowners could every 2 to 3 years live in a house and then decide to sell their home, move to another home B, and then 2 years thereafter move from home B to home C. And as long as it qualifies as their principal residence, which again is a definition, I guess they have to establish domicile there, have their driver's license, they could theoretically take advantage of the capital gain tax-free loophole, every periodically, and they could keep doing it. Again, it'd have to be legitimate, and there might be some people that could do it. Anything would be subject to an IRS audit, but it is allowable. There's nothing prohibiting that.
Absolutely. And even if the IRS audit does happen, they will look at the complete fact pattern. Is it the same size house? Is it in the same area? Are you moving from state to state? Are you changing because the job needed it? Are you changing because of the health reason? Are you moving from big house to the smaller house?
Absolutely. I mean, yeah, sure. Like you live in a large home, and then when kids all graduate and empty nesters, so you want to take advantage of the high market, sell it. You move to 2-3 bedroom townhouses, and after 3 years later, you say, you know what, my knees is really hurting. I want to rent, or I want to move in 55. I did had a client, right, sold a big home, moved to 55 plus, a newer home, and then decided I'm too young for that.
Yes.
So that one moved back to the ranch. So,
right.
That's a good reason to do that. Yeah, absolutely.
And under most circumstances, there won't be too much capital gain. It's not like we're talking about the capital gains typically of $250,000 to $500,000, or if you've lived in the house for maybe 15, 20 years. So if you want to play that game or that route and move every 2 years, you might break even or you might lose money when you take into account the closing costs. So that's another reason why it's not like every 2 years you're going to make $100,000 tax free. You'd be lucky, So it's really not. So I guess the IRS is smart enough to know that it's really a long-term reward to like the homeowners that bought their house 20, 30 years ago. Maybe they want to retire, so they give them a break, and they're not going to crush them with the capital gains as long as the profit is within reason. If you're going to make too much money, the IRS is going to say, you know what, if you're more than $500,000 married, we want a piece of it. Unless you can further reduce the gain by increasing your step up your basis.
Cost basis, right.
From the other point of view, right? I'd rather have that problem. If I have to pay the tax, means I made more than 500.
Absolutely.
Yeah, and then I pay you 15% or 20%.
Sure.
I mean, from whatever I gain. So I had a 500 in my pocket first, and then I deduct the new roof, new siding, everything, maybe another few dollars left, and I pay 15, 20, or 20%.
Absolutely.
That's a good problem to have.
That is.
Paying the taxes, right? A lot of people said, they hate pay taxes, right? I remember when I was younger, I was assistant that time. And one day I came to work, said to my boss, I'm very upset. Now I have to, pay extra taxes because I had the saving, I have the interest, whatever. I have to pay tax. My boss said, that's a good problem to have. At least you have a savings.
Absolutely.
You have to look at it from the bright side, right?
You're absolutely right. You're talking to a CPA. I mean, taxes excites me. More taxes. I compare not the income. I compare the taxes, how much I'm paying. And if I'm paying more taxes than the last year, it actually makes me happy. It probably means I made more money.
I made more money. Yeah, that's right. Yeah. This really depends on which perspective you look at it, right?
Absolutely.
Yeah, you look at the tax bill, you said, oh my God. But as you said, you look at the water half full, half empty.
Absolutely.
If you look at your income, so, oh my God, that's how much we made this year.
Yes,
that should be a happy moment, right?
Exactly. It all depends on which perspective. Like our daughter would say sometimes, they'd say, Maria, you have to walk, you have to run more. And she'd say, I don't want to run, I don't want to walk, but she should be happy that she's healthy and young enough to walk. Because when you get older, when you get to be really old, people would die to be able to.
Exactly.
Yeah,
right?
exactly.
So it's all relative. Let's talk about another important topic: the New Jersey exit or withholding tax and this I guess would apply, AJ, to sellers that sell their prime residence and then move out of New Jersey.
It typically applies to the investment property, not mostly to the primary home, but it can can apply in either case, and they call it bulk tax or exit tax. So infamously, New Jersey is infamous about charging people who are trying to leave New Jersey, that if you leave New Jersey, then we'll charge you additional taxes. But it's not additional. It's just it's been advertised this way. It's not additional taxes. It's the way the state government looks at it. Once you move out of New Jersey, it's very hard for the state government to chase you down. We have no way to collect our money from you. So at the time of sale, they wouldn't give you the clearance. They wouldn't really let you sell the house unless you pay estimated taxes.
That's right.
When you file the taxes, if you do decide to file the taxes, then whatever taxes you paid, you can claim those taxes against your actual tax liability. Let's take an example quickly. Let's say you are selling a home investment property, and the attorney is saying, the New Jersey wants an exit tax of $10,000. This is an additional money, and everybody is upset. They call the accountant. What is exit tax? Why am I paying $10,000 to New Jersey? And the accountant says, no, this is how it works. Pay $10,000. On this property, when you actually file the tax, you show the proper gains. This is my gain, and let's say New Jersey tax turns out to be $7,000, not $10,000. You can claim that $10,000 was paid in advance, and they will give you $3,000 back.
Right. So it's really more like a withholding, an estimated
Absolutely.
tax. It's really not they're punishing you. They're just,
not
just making you prepay or pre-withhold a certain amount of money. I think it's usually a percentage of the sale price, like 2% or
well, no, it depends. It could be as high as 9%, could be as low as 2%, and it's computed on the bulk sales tax form. The New Jersey has a form where they have the selling price, the cost basis, the settlement charge, all the numbers are put in. Typically, accountants fill up this form, and the taxes could be minimum 2% to as high as 9%. But this is, at the end of the day, an advance tax payment, an estimated tax payment that you're making to the state government. This is not an additional tax. There is no penalty. There is no punitive angle to it. When you actually file the taxes, you can claim the taxes that you have already paid as a part of the estimated tax payment.
Right. I think it's
have a
because
question.
I just think one thought, Jane. I just think New Jersey does it because they don't want you to forget about the beloved state of New Jersey. They want you to remember to come back and send and ask and file your taxes. Otherwise, you're right. But no, as you said it best. It's basically because New Jersey knows that if people move out of state, they're going to forget about New Jersey, and they might forget to file that tax.
It's very hard. If you consider the whole picture, and if people owe $5,000, $10,000, by putting somebody to chase you down in California will cost New Jersey more than $5,000.
Yeah.
And the second angle could be the cash flow. Give me the money now. If you file it, great. If you don't file it, who cares? I got the money now. So from a New Jersey perspective, they are looking at the cash flow. They want the money today as opposed to tomorrow. So they are forcing the system to collect the money in advance. So from a cash flow perspective, it's better for the state. From the chasing down perspective, they don't have to assign the resources to chase down somebody who moved out of the state.
Right.
They have collected the money. If you want the refund back, you file it.
They have to hire New Jersey. Say if the person already moved on to California, so they normally they have nothing to do with New Jersey anymore. In this case, as per you said, they have to hire accountant like you in New Jersey to fill in the paperwork in order to get that refund.
Well, I don't want to create this perception. Any accountant can file taxes in any state. So in this example, let's say if they moved to California, their Californian accountant can file taxes in New Jersey as well. They don't necessarily have to hire somebody from New Jersey. So I can file taxes in California as well. I can file taxes in all 50 states. And so most accountants...
Federal level, not the state level, not like real estate. I only can practice in New Jersey. I can't go to California.
No, from a CPA perspective, we can file taxes in California, and Californian CPA can file taxes in New Jersey. So for a seller, they don't necessarily have to hire somebody from New Jersey to get their money back. And they only need to file taxes in the first year. Let's say if somebody moved out of New Jersey in 2022 to California, they are out of New Jersey. And New Jersey withheld certain taxes. So for 2022, they have to file taxes in New Jersey to get their money back. But going forward, they have no connection to New Jersey. In 2023.
How about if they forgot the first year? Can they come back second year and say, I forgot?
There'd probably be a penalty. Maybe,
no, there won't be any penalty as long as they are expecting a refund. There will be a penalty if they owe money. Let's say if they paid $10,000 in estimated taxes and the actual tax liability happens to be $12,000. More than what they paid.
Right, then there'd be a penalty.
Then there will be some penalty.
Was withheld by the taxpayer, right?
But they have 3 years to go back and request.
3 years. That's very important. 3 years.
Yeah. Okay.
Check your book.
Yeah. Unfortunately, we're out of time. We didn't get to cover investment properties, the benefits of rental and the deductions, and also 1031 exchanges, and then bulk sales. So AJ, we're going to have you come back.
It's really my pleasure.
Yeah, but I want to thank you very much for coming on. And once again, if any of the listeners would like to get in touch with you, please give your contact information.
Absolutely. Ajkumar, CPA, and you can call me at 908-380-6876. And just one more time, as Ken mentioned, the information we are giving is general information in nature. Everybody's situation is different. Please check with your accountant, call us to discuss your specific situation before making a final decision.
Yep, well said. Thank you again, AJ. We really appreciate it. And to our listeners, we'll see you next week, and have a great rest of your weekend.
Thank you.